Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. Last week, I started discussing areas of how to protect yourself from paying too much on your healthcare costs. Now, there are certain things that we can't control, and there are some things that are surprisingly able to control with how much you pay in health insurance, how much you pay for prescriptions, healthcare, surgeries are a little bit flexible if you know what you're doing and how to navigate. So I wanted to share with you last week, and I wanted to continue with you this week, different methods of how to manage your healthcare costs. So let's pick up where we left off last week. Ideas for how to help save money deal with what is within your control and knowing what those factors are. And here's one of them. You can actually earn cash for some wellness programs offered by employers. So what we want you to do, more than a quarter of large employers surveyed by the Kaiser Family Foundation offer gift cards or cash to any workers who participate in any type of a welfare program called a wellness program. So when you go through your employer, I want you to ask, if you're working for a large employer, do you offer any gift cards or cash for wellness programs? Large employers surveyed by the National Business Group on Health added an average of about $350 to an employee's health savings account for participating in a wellness program. They can't or won't do that a lot of times if they don't know you're asking them to contribute. So make sure you're not missing out on special programs available through your employer. Now, I want you to get credit for your deductible, especially if you have a high deductible health plan. Make sure you're getting credit toward the deductible for all of your care. So even when you're paying out of pocket during the deductible period, you have to file the claim so that you'll get the rate the insurer negotiated with the provider. You check your explanation of benefits. Make sure you receive credit for costs that count toward meeting the deductible and your annual out-of-pocket spending limit. So the key there is you have to file the claim even while you're paying out-of-pocket, or it may not be credited toward your out-of-pocket deductible. All right, now, time your procedures carefully. I talked about this a little bit last year, and I'll talk about it again today, or last week rather, and I'll talk about it again today. And that is you time your care if you have a choice on if you're late in the year. Let's say consider scheduling procedures near the end of the plan year versus plan your procedures in the beginning of the following year. Here's what makes the difference. You consider scheduling procedures near the end of the year in years that you've already met your deductible. So think about that rather than waiting to the new year when you have to start a whole new deductible all over again. On the other side, if this is an issue where you haven't met a deductible, you may not want to plan care near the end of the year, start meeting a planned deductible now, and then have to start all over again in January, meeting a whole new deductible. So weigh these options carefully. As long as it does not affect your health, you want to weigh these options. You want to go through and plan so you're only paying a deductible once if you could possibly avoid it. Now, how about enjoying a triple tax break from a health savings account? The way you might be able to do that is this. If your health insurance policy has a deductible of at least $1,250 for an individual or $2,500 for a family in 2014, you may be eligible to open a health savings account. Now listen. A health savings account lets you set aside tax-deductible money or pre-tax money through an employer. If it's through the employer, If it's not, it's after tax, basically tax deductible money on your own to open up a health savings account that you can use tax-free in any year to pay your insurance deductible and other out-of-pocket medical expenses. So think about this, folks. If you have a deductible of at least $1,250 for an individual or $2,500 for a family in 2014, you may be eligible to open a health savings account. That's very important because now you're able to set aside dollars that are tax deductible contributions to that health savings account that you can use tax-free then in any year to pay your insurance deductible and other out-of-pocket expenses, which otherwise would not be tax-free, as you know, and the contribution toward them wouldn't be tax deductible. So it's a huge benefit. Now, let me show you something else. In 2014, you can contribute up to $3,300 to a health savings account for individual coverage, or get this, up to $6,550 for family coverage. Plus, it gets even better, an additional $1,000 if you are 55 years or older anytime throughout that year. So that could be as high as $7,550 for the year. You can contribute tax-deductible money and use on a tax-free basis toward otherwise uncovered or what would be self-covered medical expenses. That's huge, folks. So these high-deductible plans that you're considering when you're shopping, and you say, oh, wait a minute, I don't want a high-deductible plan of, like I said, $1,250 for an individual or $2,500 for a year for 2014, reconsider that, because you're able to then possibly qualify for opening up a health savings account. Now, you can get free health savings account money sometimes from an employer. Many employers, and again you ask, match health savings account contributions or seed your account after you sign up. And what that means is they'll match sometimes up to $500 for a single plan, maybe $1,000 for family plans. And you'll look at this and you'll say, I'm missing the boat. I'm not asking the right questions to my employer, and I've not heard of any of these options that I'm bringing up on the show before. So that's why you need to keep tuning in. I keep bringing things in all areas that I can think of people's financial lives and businesses' financial affairs that I could possibly shed some light on, help you make more of your money. What I'm trying to do is help you make the most of your money in this show. So I bring up different areas on each week's show. I might be talking life insurance one show. I might be talking taxes the next show. I might be talking asset protection the next show. Maybe estate planning after that. Maybe saving for college financial aid and scholarships. I've discussed all of these things on my shows, and it's because the things that I'm running across, beneficiary designations maybe not matching, all kinds of things that I'm running into, I try to share on the show to help everyone benefit, not just certain clients. All right, let's take a quick break, and I'll be back with more health savings ideas in just a minute.
If you're a business owner or an independent contractor, you know the cost of doing business. You have your equipment, your personnel, advertising costs, and doing everything you can to outdo the competition. But do you run your business, or does your business run you? Your business is truly an investment. Is that investment insured? Jack Driscoll is here to help. At Driscoll Insurance and Financial Services, he provides complete business planning services ranging from property insurance programs to disability, life, hospitalization, and long-term care programs. He not only designs insurance protection plans tailored for your business and protects what is already built, but strives to strengthen your business through providing employee benefit and group programs. It's through this unique combination of skills that Jack has become a valuable resource for business owners and managers. Educate yourself first by going to DriscollFinancial.com and clicking on Business Insurance, or give Jack a call at 412-833-1500. Your business and your employees need you to be prepared, and you need to be protected. Log on to DriscollFinancial.com or call 412-833-1500. Driscoll Insurance and Financial Services. Insure for today, invest for tomorrow.
Okay, let's get back into some more money-saving ideas with your healthcare and how to be more efficient with your dollars. Let's look at this health savings account I brought up right before the break. you can boost your health savings contribution limits, if you think about it, in any year that you started, let's say an HSA, which I'll refer to the health savings account, HSA, eligible health insurance policy. Now let's say you have that policy on December 1st, and you just start that policy, but it's an HSA eligible policy. That means you can make the full year's contribution, even if you've had the plan for only a month, and qualify for the whole year's worth of contribution if your family up to that $7,550 contribution limit, get a tax-deductible contribution for the year and still be able to make tax-free distributions to pay the health care expenses in the following year. Now, there are a little bit of regulations for that. If you didn't have the HSA eligible policy for the full year that you made the contribution, you must keep the plan, the policy, for the entire following calendar year or pay a penalty. So if you drop the policy, if you picked it up December 1st, or let's say you started work July 1st or started this plan July 1st on your own, you could buy it individually. By July 1st, that's a partial year. So if you drop the policy the following year, you'll have to pay income tax. So you lose the tax deduction, you'll pay that tax savings back, and a 10% penalty on the difference between the amount you contributed and the amount you would have been eligible to contribute based on the number of months you had the HSA eligible policy. So in other words, don't do it. Don't cancel a policy the year following the first year you contribute on a partial year, and you'll be safe. So that's a very important point there, where you can actually maximize the effect, because you could put $75.50 in December and put $75.50 again in the following year, and in January, let's say, and still qualify for both years' tax-deductible contributions and tax-free payouts on qualified health care expenses. Now, it gets better than that. You can actually use your health savings account money in retirement. It's because health savings accounts don't have a use it or lose it rule. You can keep the money growing in the account and use it tax-free to pay for future medical expenses, even after you've retired. You can't contribute to an HSA after you sign up for Medicare Part A or B, but you can still use the money that you already have accumulated for co-payments, deductibles, prescription drugs, vision, dental care, and a portion of your long-term care premiums even. You can also use the money for Medicare Part B or D or Medicare Advantage, but not Medigap premiums. So that's important, because it's not a use it or lose it by the end of the year type of a benefit. Very helpful. You can also contribute to an HSA after you're age 65. Now remember, I said you can't contribute after you apply for Medicare Part A. And Medicare Part A is typically what we apply for at age 65. But even though you can't contribute for it after you sign up for Medicare, you may be able to delay Medicare enrollment past 65 without a penalty and keep adding to an HSA instead, which could be a good strategy if you're still working and if your employer adds money to your account. So, again, one of the exceptions to not having a penalty for contributing to Medicare by the time you're 65, there's a penalty of 1% every year you miss that. And I've talked about that in prior shows. But not if you're still working, actively employed. That's one of the exceptions. So it may apply where you don't apply for Medicare Part A, you're already over age 65, you're still fully employed, you're still contributing tax deductible to an HSA, and you're not in violation of that because Medicare Part A and B enrollment past 65 is an option under certain cases if you're fully employed. So check the regulations, see if even though you're 65, there won't be a penalty in your particular case. Find out to make sure there isn't a penalty. And if there's no penalty, you may be able to extend contributions to an HSA even after that. All right, now, how about this? You can make a one-time tax-free rollover from an IRA to an HSA. Let me repeat that. You can make a one-time, lifetime, once-in-a-lifetime, tax-free rollover from an IRA to an HSA. Most people don't know about that. If you have an HSA eligible policy, you can roll money over from a traditional IRA to the HSA so you can avoid a tax bill when you withdraw money from what would have been the IRA for medical expenses. You've rolled it over into an HSA, tax-free, and now when it gets pulled out for HSA for medical expenses only, it's not taxable, folks. That's a unique strategy most people aren't aware of. Maybe without listening to the show, you wouldn't have been aware of it either. But you or some friends that you know might need to know that strategy. That might be very helpful. You can make the tax-free rollover only once in your lifetime, up to the annual HSA contribution limit. That's the most you can do, minus any contributions you've already made for this year into the HSA. So it's not hundreds of thousands of dollars, but it is a tax-free rollover you can use. You must be enrolled in an HSA eligible policy for 12 months after making the transfer to avoid penalties. Okay? So contact a tax professional, your insurance professionals, better yet, a certified financial planner who understands all of these different provisions and help guide you through this. Please do not try to do it yourself. You're destined to make a mistake. A little bit of knowledge is dangerous. So in listening to the show, I'm teaching ideas, but not applications. I'm teaching ideas that may put light bulbs on in your head. Hey, wait, maybe this will work for us. I need to take the next step to find out. And that next step is not researching it on yourself, not trying to do it yourself. It is contacting a certified financial planner who is skilled and well-versed and well-experienced in all of these different areas to help you coordinate your tax concerns, your health concerns, your IRA concerns, your retirement concerns, and your medical concerns. Help tie all those together and help you make the best decisions in what's suitable for you. All right, let's take a quick break, and when I come back, I'm going to talk about the difference between health savings accounts and flexible savings accounts, and they are very different, but offer some of the same benefits, and how to choose which to use, which might work best in your circumstance. We'll be right back.
Most would agree that no one could put a monetary price tag on our lives. You and I are truly priceless. However, the cost to our loved ones could be dramatic if we don't prepare for the challenges they may face should we pass away. Driscoll Insurance and Financial Services has a great tool on their website, driscollfinancial.com. When you click on the link for a free life insurance quote, you can see the different opportunities available for term life insurance from several providers, including some well-known companies. All you do is answer a few questions about yourself. It literally takes seconds, and you may be surprised to see how affordable term life insurance can be. Experts recommend that you carry life insurance equal to 8 to 10 times your annual salary. So what are you waiting for? Go to driscollfinancial.com and get a free quote. And while you're there, check out the vast array of services that Jack Driscoll has to offer. Or call his office in Bethel Park at 412-833-1500. That's 412-833-1500. Driscoll Insurance and Financial Services. Insure for today. Invest for tomorrow.
Okay, let's get into this difference between health savings accounts, as I promised before the break, and flexible savings accounts, which are also available. If you find from your employer that the health savings account is not available, then you should ask, do you offer a flexible savings account, otherwise known as FSA, as opposed to the health savings account, which is HSA. Now, if your employer offers one, then you have different contribution limits, but you're able to contribute to an FSA. That is a flexible savings account. If they offer it in 2014, you can contribute up to $2,500, which escapes federal, Social Security, and Medicare taxes. So it's very beneficial to you. It's just very similar in a way to save money, even though a health savings account isn't available, if a flexible savings account is. So again, it helps you escape federal tax, Social Security tax, and Medicare taxes. And in most cases, state and local income taxes too. You can use the funds to pay out-of-pocket expenses for medical throughout the year, and many employers, this is important, and the major difference, by the way, between the FSA and the HSA, many employers allow you to carry over $500 in FSA money into the next year. Notice the difference. Remember I said on the HSA or health savings accounts, it was not a use it or lose it plan. You could carry those funds forward. Any unused funds in the plan could be used up to retirement and even after you retired until those monies were used up. It was not a use it or lose it plan. Unlike the FSA, which really is a use it or lose it plan, but most employers can put into their plan documents the ability for employees to have up to $500 be able to be extended into the following year to be used. You know, the FSA accounts, you can use that money tax-free, just like the HSA accounts. You can use it to pay your deductible, co-payments, medical and prescription drug expenses. You can use that aren't covered by insurance, of course. You can use it as well as eyeglasses, prescription sunglasses, contact lenses, prenatal vitamins, breast pumps, cold packs for your knee, thermometers, ankle braces, blood pressure monitors, all these different medical expenses that you can purchase tax-free rather than after-tax dollars. So the flexible savings account is quite useful. Even bandages, first aid kits. So you want to know about these plans. If they're available through your employer and the HSA is not, you want to take advantage of these. Now, you can even use some sunscreens as an eligible expense for these flexible savings accounts on a tax-free basis you're spending on those. Here's your caveat. You can roll over some of your FSA money into the following year, but not all of it. The use it or lose it rule does apply to flexible savings accounts, and it used to be one of the biggest, if not the biggest downside to using a flexible savings account. We were always afraid as advisors, how do we counsel clients on how much to defer from their income to not have to pay tax on that income, which is a benefit, and be able to use tax-free for medical expenses, but knowing at the end of the year, if we put aside too much and it wasn't used for medical expenses, it was lost. Those funds would have been better off having been taxes deducted and paid and taken out as our paycheck and not used as a tax-free medical expense, as opposed to the whole amount being lost. So it was always a gamble. Now there's a little buffer, but only up to $500 if your employer provides that in their documents. And not all do, so you have to check with them. But if they provide for it, there's a buffer of $500 that can be rolled over for the next year. Employers aren't required to make that change, but a lot of employers have made it. So that's what you need to know, the difference between health savings accounts, which are the more preferred, and flexible savings accounts, which are less preferred, but still preferred. That's what I wanted to wrap today's show up with. We have more ideas I wanted to share with you. I will do it again on next week's show. I'll share with you more ideas on how to save money on your healthcare expenses. Thanks again for tuning in to All Things Financial. We'll be back again next week.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.